Hello everybody, I hope all of you are doing really well. My name is Siddhant Mehta and welcome you all to Raftaar batch. This is part 2 of your chapter number 6 and today we are going to revise about fixed income securities. But before that, I hope you remember the two instructions which I had given you. The very first one is about feedbacks. Give us your valuable feedback. Let us know how all these things are helping you and what all things we need to improve, whether it is in revision lectures or it is in last minute notes. The link for the feedback form is in description box. And the second most important instruction is to subscribe our channel, because the way we are delivering value to you in set C, in the same way we are going to deliver it in set D. So let's now understand the common types of fixed income securities. There are some securities which are issued by the government, then by the corporates, and then by the bank. Let's first understand the securities which are issued by government. The first one is a treasury bill. It has a maturity of less than 1 year and these bills doesn't have any interest, because you will purchase this bill at a discount and after 1 year they will be redeemed at face value. Give you an example, if there is one treasury bill of face value 100 rupees, you will purchase it at 95 rupees and after 1 year you will get 100 rupees. So here your return is 5 rupees and here you will not get any interest. Then the second is treasury notes. The maturity of these notes are 2 to 10 years. Here the interest will be fixed and it will be paid semi-annually. Then there is a treasury bonds which are issued by the government having a maturity of 20 to 30 years. Here also the interest will be fixed and it will be paid semi-annually. And then there are the most interesting securities, that is TIPS, Treasury Inflation Protected Securities. Here the maturity of it will be vary, either it can be short term or long term, but the most interesting thing is here the interest will be adjusted with inflation, because your principal will be adjusted based on inflation. To give you an example, if the face value of your securities is 100 rupees and at the time of making interest payment there has been an inflation of 3%, so your principal will be adjusted by the inflation and the adjusted principal will be 103 rupees, that is after considering this 3%, and your interest will be paid on this adjusted principal. Hence it is called as interest which is adjusted with inflation. So all the securities which are issued by the government have a very low level of risk. Then the corporate bonds are issued by the corporates. Here the maturity will vary, either it can be short term or it can be long term. Here the interest can be fixed or it can be variable, and the risk will be low to high depending upon the credit rating of a company. If the company has a higher credit rating, then definitely there will be a low risk. Low risk means low return. Here the lower yield is a fancy name which is given to return. So your yield means nothing but return. Then the next bond is high yield bonds, that is high return bonds, which is also called as junk bonds. These are issued by the corporates. Here the maturity will vary, and as the name suggests, high yield, high return, here your interest will be higher and the risk will also be high, because these are the bonds which are issued by low credit rated companies. So risk is high, so return is also high. Then there are certificates of deposits which are issued by the bank having maturity of 5 years. Here the interest will be fixed, it is time deposit, and these rates are higher than your savings accounts and all your deposits will be insured. Here definitely the risk is very low. So the bonds are the debt instruments which are issued by the government, corporates and entities having key features like maturity, principal and coupon rate. Let's understand some key terms which are used in bonds. Maturity means the date when the issuer will repay the full principal amount. Then tenure, this is the remaining time until a bond reaches its maturity. Then there is par value, which is also called as your face value. This is the amount which issuer agrees to repay at maturity. Then there is a coupon rate, which is also called as annual interest rate. Then there are zero coupon bonds. These are the bonds which have similar features like treasury bills. Here the bonds will be sold at discount, which will have no interest and are redeemed at par, which is at your face value upon maturity. Then there are fixed rate bonds. Here the interest rate will be fixed. And then there are floating rate notes. Here your interest rate will vary dependent on market rates. Then there is a current yield. As we discussed, yield means return and current means your current year return. So if you, this current yield tells you that if you buy the bond at current price, what return will you have for this current year? That means it is calculated by annual coupon payments which you will receive in this year divided by the bond current price. It will be expressed in the form of percentage. This is your current yield, return which you have for this current year. And then there will be a yield to maturity, that is nothing but the total expected return if you held this bond till maturity, assuming that your reinvestment of coupons. So after seeing this current yield and yield to maturity, you must have one question, that sir, if my bond is giving me 5% return as an interest, then 5% interest is my return, right? I will explain it to you with this example. So if I'm my bond is giving me 5% interest rate, that is 5% coupon payment, so my return is 5%, right? Then why there is a need to calculate YTM or current yield? My friend, bonds are same like your stocks, they are also traded in active market. So sometimes they will be trading at premium and sometimes they will be trading at discount. Your 5% coupon payment will be 5% return only when you are purchasing the bond at the face value, that is at par value. But in markets, sometimes your bond will be traded at premium, sometimes will be traded at discount, and you have to buy at that price. If you're buying the bond at a premium price, then you will have less return, because the face value of the bond is 100 rupees and you're buying it at 120 rupees, you're paying 20 rupees extra, and at the time of principal repayment you will get only 100 rupees. So you have paid 20 rupees extra, so at the end you will have less return. So high price, less return. And if you are buying that bond at discount, you're buying the 100 rupees bond at 80 rupees, you have paid 20 rupees less, but at the time of principal repayment you will get 20 rupees more. So if you're buying bond at discount, you will get higher return, and this higher return or less return which is there in premium, you can understand with the help of current yield and YTM. That's why we calculate YTM or current yield, because we buy the bond at current price and not at the face value. So if you're buying the bond at less price, your return will be high. If you're buying the bond at high price, your return will be less. These are inversely proportionate. Let's take one example for current yield. Here the bond was having 5% coupon rate, was have a face value of 1000 rupees, but the current market price of the bond was 1020 rupees. So we will buy this bond at current price, that is 1020 rupees, and the interest rate will be 5% on face value, that is 50 rupees. So your current yield is annual coupon payment 50 divided by the current price at which you buy this bond. Will have a current yield of 4.90, which is 50 divided by 1020. So this is your current yield. Let's understand about bond pricing. So to value the bond, we use discounted cash flow, because here we can predict the interest which we are going to get. We also know how much principal we are going to get, and we also know at what time we are going to get. So discounted cash flow is the right way to value this bond. Here we will consider the coupon payments, principal amount, market rates, and the bond price will represent the present value of these cash flows. Here we will calculate this present value by discounting it with market rate, and this market rate is equal to your YTM or IRR. Now you will have one more question, that's sir, why we specifically take market rate for discounting? Let me explain it to you with the help of this example. Why we take market rate for discounting? Like I said earlier, your bonds are also traded in active market. Either it can be traded at premium or it can be traded at discount. So if I want to invest in one company A, which are issuing the bonds at 5 years maturity, here the par value of this bond, that is face value, is 1000 rupees, and the interest, that is coupon rate, is 6%. But in markets there are other companies which are issuing same types of bond at 8%. So the market rate is 8%. Then why would I specifically invest in this company which is giving me 6% as an interest? So what I will do here is I will calculate the cash flows which I am going to generate from this bond. So 6% into 1000 is 60 rupees, which is my interest, which I will generate for 5 years. And at the end of the 5 year, I will get 1000 rupees, that is my principal repayment. And what I will do here is I will discount all these cash flows with 8%. Once I discount all these cash flows with my 8%, that is market rate, I will get the present value, that is 920. And my friend, this present value tells me that if you invest in this bond at 920 rupees, then you will be able to generate 8% return, which is equal to market rate. What I said, if you invest in this bond at 920 rupees, then you will able to generate 8% return, which is equal to market rate. So even in this bond, you can generate 8% return, but the only condition is you have to invest at 920 rupees, because here you are not only getting interest as a return, you will also get 80 rupees extra as a return, because you are paying 920 and you will getting 1000 rupees as a principal repayment, which will make it effective return of 8%. So this present value, that is 920, is called as price of the bond, because at this price only investor will be ready to buy this bond. And in textbook and also for our exam purpose, this present value is called as traded price, because in textbook it is assumed that this will be the price at which the bond will be traded in active market, because all the demands from the investor will be at this price only. So this will be the traded price of the bond in market. So if this price is lower than par value, which is your face value, then it is said that your bond is trading at discount. And if this present value, which is also called as traded price, is more than your face value, then it is called as trading at premium. Let's take some examples. So here company's NCQ issuing one bond which has a 5 years of maturity, have a par value, that is face value of 1000, coupon rate is 6%, and the market discount rate is 8%. So we'll consider all the interest payments and we'll discount it with 8%, that is market rate. We will get 920 being price of the bond, also traded price as per your textbooks, and it will be assumed that it will be said that it is trading at discount, which is because 920 is lower than your par value. Then one more example where your coupon payment is more than market rate. Here your coupon payment is 8% on your bond, but in market there is 6% rate. Other companies are giving 6%. Your company is issuing the bond with 8% return. So definitely it will be at premium. And it will be said that your company's bond is traded at premium because its price is more than its face value. And if there is one situation where your coupon rate is 7% and also the market discount rate is 7%, they both are the same, then it will be said that means your present value will be 1000 rupees only, which is equal to your face value, and it will be said that your bond is trading at par value. So here you can see that is market discount rate is equal to YTM, that is yield to maturity. The definition of yield to maturity is total expected return if the bond is held till maturity. And this example, you can see that if you buy this bond at 920, the return which you can expect is 8%. So the market rate which you used for discounting is also your YTM, that is yield to maturity. And this is just a summary what we have just discussed now. Just go through it once. Now let's understand YTM assumptions. So here ICAI has not given any question about how to calculate YTM if there are only cash flows given to you, but they have given YTM assumptions which are required for the calculation. So we will just go through this assumption. If they ask you any questions on assumptions, it will be only on these 3 points. So YTM assumes that the bond is held until maturity. This is a simple thing. Issuer is also makes all the payment on time. That is, company will make all the payment on time, and the coupons that are your interest are reinvested at the same YTM. That means if your bond has 3 years of maturity, so the interest which you will get at the first year, you will reinvest that interest for 2 years at same YTM. So if your YTM is 5%, then you will reinvest at 5%. The coupon which you will get at second year, you will reinvest for 1 year at 5%. This is what it is assumed. You don't have to calculate for this reinvestment separately. You just have to assume it that all the coupons which you are receiving are reinvested at same YTM. These are the three assumptions which you take in YTM calculation. So your discounting rate is nothing but the rate which you use to discount your cash flow. Like here we use 8%. If this 8% is not given in your question, then what you will use? So if it is government bond, then you will use risk-free rate plus inflation premium. And if it is corporate bond, then you will use risk-free rate plus credit spread. This credit spread will be depend upon the credit rating of a company. So these are the rates which you will use if market rate is not given to you. Now let's understand the complexities in comprehensive valuation and how it's impact your valuation. The very first one is credit risk. The risk that the company will fail to make interest or principal payment. If there is high credit risk, that means investor will be only interested in your company specific bond if you are giving a high return, because if risk is high, he wants high return. So if yield is high, that is return is high, then your bond price will be less, because as we discussed earlier, if you are increasing your return, then your price should be less, because they both are inversely proportionate. Here we have seen that if we have to have higher return, then the bond must be at discount, where we have taken one example that if the face value of the bond is 100 rupees, which is giving me 5% as an interest. So if I purchase this bond at 100 rupees only, then I will get 5% as an interest and also as an return. But if I purchase this bond at 80 rupees, then at the time of principal repayment, I will get this benefit of 20 rupees. I have paid you 80, but now you are repaying me back of 100 rupees. So this 20 rupees will help me to have higher return. So the only possibility in bond is if you want higher return, then your price of the bond must be at the discount. If you want to increase your return, then your bond price will be decreasing, because they both are inversely proportionate. Then your second is yield spread. Here the difference between the bond yield, that is the return in your bond, and the risk-free rate. If the difference is wider, that means your bond return is more. So if your bond return is more, then the price will be less. Then there is default probability model. Here, with the help of statistical model, you will predict the likelihood of default. If there are chances that there is going to be default, then the risk is more. If risk is more, then return is more. If return is more, then the price will be less. Then there will be a spread analysis. Here you will compare the bond yield spread to similar rated bond with other companies. If there is a higher spread means higher risk, high return, but bond price will be less. Then management quality. If you have good management quality, if you have good management persons with you, if your management is strong, then definitely this is a good sign, and there will be a less risk in your bond. If there is a less risk, then less return. So yield will be less, but price will be more, because they are inversely proportionate. Then legal covenants. That means you have made bond agreement that impose financial restrictions on issuer. There are some restrictions on the issuer which he has to maintain, like some financial ratios which company has to maintain throughout this bond. If such conditions are there, then definitely there will be a less risk for the investor. If less risk, less return. That means less yield, but high bond price, because inversely proportionate. Then market liquidity, the ease at which the bond can be bought or sold in the market. If there is a lower liquidity, then you have to compensate it with higher return. So high yield means low bond price. Then discounted cash flow analysis. That means if you have higher expected cash flows, then definitely your bond price will be high. And market-based valuation means comparing your bond with similar bonds in the market. If you have higher relative yield, if your return is high, then your bond price will be less. Now let's understand if there are any defaults in payment, how you will adjust it in your bond valuation, which is called as expected credit loss model. So this model helps us to estimate the potential credit loss in fixed income securities by considering default risk. So there are two methods for it. The very first one is about adjusting expected cash flow, and the second one is adjusting the discounting rate. So in the very first method, what we will do is we will expect, okay, what is the amount which I am going to get? Okay, the 100 rupees is what I am going to get. What is the probability that I will get this amount? I think there is a default that they will make default. There is a default probability, I'm sorry, of 2%. So the chances that I am going to get this amount is 98%. So I will multiply 100 rupees with 98% and I will consider this 98 rupees as my adjusted expected cash flows. So since some issuers will make default, the expected cash flows are adjusted based upon probability of defaults. This means investor will assume that they won't always receive the full amount, making the bond appears less valuable. So if the default probability is 2% and $100 rupees payment, I will adjust it with 100 into 1 minus probability of default, that is 98%. 100 into 98%, I will get the amount and I will discount this amount for my present value calculation. This is the first method. And in second method, what you will do is you will increase your discounting rate, by which your present value will be lower. Here, instead of adjusting cash flows, the risk-free rate is increased by adding an expected loss provision. This means that the future payments are discounted at higher rate. If you're discounting your future payments at higher rate, then your present value will be lower. For example, if risk-free rate is 4%, then the credit risk premium, which you are adding specifically for this default risk, which is 3%, then you have to discount your cash flows by 7%. That is 4 plus 3. So the impact on bond valuation, this is just the summary. If you are doing it with adjusted cash flows, then your future cash flows will be definitely lower, by which your bond price will be lower. And if you are doing it with adjusted discounting rate, then your discounting rate will be higher, by which your bond price will be lower. The limitations of this model are, here the entire accuracy of your valuation is dependent on default probability, and how well you predict these things, at that thing your valuation will be dependent. And there is future uncertainty, right? Because how much default in cash flows there is going to be, you're predicting it based upon the trends. The model is based on historical trends and current conditions, which may not always predict the future defaults accurately. So these are the two limitations in ECL model. Now let's understand our last concept, that is issuer versus investor perspective in bond valuation. Let's first understand issuer's perspective. Issuer's primary concern will be minimum cost of capital. He will always try that company should pay minimum interest to the investor from company's pocket, but that interest should also attract investors. Then he will also try to maintain a strong credit rating, because if he has strong credit rating, then there will be a low risk. Low risk means low return, that means low borrowing cost. He will always have to balance competitive yields with affordability. Though he is giving higher return, but whether he can afford that higher return, then he should offer attractive securities to the investors, and he should ensure that bonds are appealing enough to be tradable in a market. Then the investor perspective will be, he will always try to have maximum return but managing risk. Then he will always assess the issuer's credit risk, that is company's credit risk, to ensure that whether the return given by the company on a bond is justified. He will see the potential returns from the bond against the associated risk. He will also check how easily the bond can be bought or sold in the market, and he will find the fairly priced securities with good risk adjusted returns. So this is the end of your part 2. I hope you are finding these lectures and our notes valuable. If you are loving these lectures, don't forget to like and subscribe to our video. तब तक मिलते हैं अगले लेक्चर में. टाटा, बाय बाय, सी यू.